Good news you can use with that Mahone, yeah. She got the good news you can use. Good news you can use for your life.
Hello again, and welcome to this edition of the Boomer Beat with your host, Beverly Mahone. And today we are going to talk about retirement in a rather unique way. And it gives me great pleasure to introduce to you our guru for the next 30 minutes, Ryan Ponsford, who is with AAG Mortgage. Hey, Ryan, how are you?
Good morning, Beverly. I'm well. How about yourself?
I'm doing very well. Now, for those of you who are on the East Coast, he is actually in California, so he's saying good morning because it really is morning there. All right, so let me first of all just ask you to let our viewers and listeners know more about you.
All right. Yeah. So my story is kind of unique. My background's in financial services. My degree is actually in industrial organizational psychology, which is a little bit interesting in itself.
Yeah.
But somehow ended up in finance. And I was in private banking for quite a few years where we dealt with pretty affluent families. And in that, I noticed that there's some unique characteristics of families. And you try and figure out how people create wealth and how they maintain it and all this stuff. And along the way, I realized that there were some characteristics that were consistent. One is sometimes wealth was great for families, and sometimes it was a real challenge for families, and it could be a real divider. And so there were points where I started really working with families around how do we create multi-generational continuity? How do we connect them over multiple generations? And one of the largest assets for a lot of people was their real estate. And so for me in the financial world, it was important to be able to address real estate challenges and opportunities in families, which is a little bit unique in the financial services space. And so I found a lot of the big institutions didn't really do a good job of really focusing on families. They didn't do a great job of incorporating real estate. And this is going to sound terrible, but eventually what I learned is a lot of institutions were product manufacturing companies, and their advisors were distribution channels of those products. And so I really wanted to focus on being more family centric. How do we put the family at the center of what we're solving? And so I went to an independent firm, and we built that for quite a few years. Unfortunately, the owner of that firm ended up getting sick. He got pancreatic cancer, passed away within weeks, and so ended up selling the firm. And at that point, I'd launched a nonprofit organization where we were teaching life and finance to at-risk youth through the lens of philanthropy, which was actually a really cool program. It's sort of unique, and I'll take a quick second to share with you that I learned that learning to give is an incredible thing that more often than not changes the hearts and minds of those who give, even more so than the recipient. So I had this kind of question of what if we could put these kids on the giving side of philanthropy, right? That some of them have been beneficiaries of different organizations and things around the country, but what if they were on the giving side? What would that do for their confidence, their ability to know they could make a difference in the world, teaching them financial core principles? And so I ended up being able to pull some money together and hung out with these kids. They were all part of the juvenile court system, and took them through this 10-week program of teaching them how to give away money. And teaching life and just generosity through it. And it was an amazing experience. So when our firm sold, I was kind of trying to figure out what to do with my life. I had a few families I continued working with. I built this nonprofit and spent some time spreading that across the country, and then got a call from some very good friends of mine that had come over to this company that I'd never heard of called American Advisors Group. I didn't know what it was. And they said, hey, Ryan, can you help us? We think there's some opportunity here with all that's going on in the world and the country and retirement and this baby boomer generation. There's some unique opportunity to help them with retirement. And I said, I agree. There's some gaps and there's definitely some opportunity. I said, what are you guys doing? They said, well, we're primarily in the lending industry. And I said, okay, great. Real estate's a big core asset for most people. Their primary residence is often the largest asset that they own. And they told me at that point that they were in the reverse mortgage space. That was really the core solution that they were looking at. So I didn't know anything about reverse mortgages other than my first response was, this takes advantage of people and the kids don't get anything. And I had all the misconceptions that most people have. And as I was trying to process this, I kept pushing them away and telling them, no, 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 this is not the right solution. And they finally challenged me. They know my weakness. They said, Ryan, can you just help us do the math? I like math and I like helping. So I'm like, okay, I will be kind to you guys. I will help you do the math because I'm such a wonderful, thoughtful gentleman. And so I did. And when I did the math, I was absolutely blown away. And I realized there are so many unique nuances of today's reverse mortgage, which is a very broad term, by the way. But in that world of payment optionality, there's so many unique things that I hadn't understood. I knew families and clients didn't understand it. And I really knew the financial industry didn't understand how these worked. So I told them, I said, if you guys are about 60% right on what this thing can do, there's a tremendous opportunity to get the word out and educate people on how this thing works and how it can be used as an effective proactive tool in retirement years. And so that was about 3 years ago. And so since then, we've been in front of thousands of financial professionals, incorporated it more into their planning process. How do you use this responsibly? How do you understand the nuance of it? And who are the right people that will benefit from this? So it's been an interesting journey. I've learned a lot. And so now we're out trying to just share the message and help people to be reintroduced in some ways to how this thing works. I think the industry's done a relatively poor job historically of explaining what it does and how it works. So we're trying to fix some of that problem that's out there in the marketplace.
Well, hopefully we'll be able to do some of that today. And I have to share with you, Tom Selleck is the one who piqued my interest in what reverse mortgages were all about. And just about every woman I've spoken with, it's like, oh, there's Tom Selleck. Oh my God, he's still looking so good. And then you listen to the message and then you say, okay, so what are reverse mortgages? So that's my first question.
Right on. So, Tom Selleck is interesting. He is a magnet. It's, we go to events around the country and we have these large life-size cutouts of Tom Selleck. And it's amazing. People flock, mostly women. They want pictures with him. I've had people try and, buy him from us at the event. I'm like, I don't know. So I always like to ask the question, Tom Selleck, is he Magnum PI for you or is he Blue Bloods, right? And so it's interesting around the country. For me, it was Magnum PI as a kid. I always wanted a 308 Ferrari. I thought that was the coolest thing ever.
And me too. Yes.
So it's actually interesting that with him, he doesn't usually do spokesperson stuff. And so what he went through, the due diligence he went through to agree to this was actually extremely extensive. He initially said no, kind of similar to my response. And he went through a tremendous due diligence process in order to be comfortable putting his name with us, which I thought was very interesting. Not just the concept, but specifically American Advisors Group, were we the ones he would align with. So I thought that was fascinating.
Well, he has a brand. And so you have to be mindful of your brand. Yep. And you just can't attach it to anything. So that is why, like I said, it piqued my curiosity only because it was Tom Selleck. And you're right, we don't see him all over the television promoting products. So going back, what specifically are reverse mortgages and what are the advantages of having one?
Great. So I'll blanket this where there are multiple types of reverse mortgages. So there's a blanket term for reverse mortgage, which essentially in most cases means you have the option of whether or not to make payments. So it's much like a traditional loan. One of the differences, you have the option of how, if, when you make payments. Within the umbrella of reverse mortgage, there are private proprietary loans. Most of those would be more jumbo loans. So people that live in markets where their homes might be $1 million or more, a lot of times that's the kind of more private reverse mortgage. But the most common one is the government-backed and insured home equity conversion mortgage, HECM. We call it HECM because it sounds cool to say HECM. So that is the most common. Over 90% of the reverse mortgages that are done are actually under that HECM umbrella. So to give you a basic summary, I think of it almost like any traditional mortgage with an exception of there's multiple types. The most flexible is one where you're essentially replacing your existing mortgage with a line of credit. Okay, so think about it. If you owe a mortgage on your home, you're essentially going to refinance, pay off that loan with a large line of credit. In many cases, you can access, more money than you might have, but you might owe on the home. And so that gives you a tremendous amount of flexibility. Once that credit line is in place, you have the option to make payments just like you are today, right? You have the option of taking withdrawals from the line of credit. So it's almost like I don't like the concept of a credit card, but it's similar to that conceptually, where you can withdraw, you can pay back, and always continue to have access to those funds. There's some unique features that make it different than most lines of credit. It is government insured, which means they are guaranteeing your access to that equity in your home. You have the ability to set up, if you have equity in your home remaining, you have the ability to set up income streams. So I could say, hey, how much can I get for the rest of my life? And they can set up income streams that are also guaranteed by that insurance, right? There's also a very unique feature in that the credit line, the total amount that you have access to, actually grows and compounds every single month. So your total credit line is increasing. Right, unlike most loans, a traditional HELOC, home equity line of credit, or any other traditional loan, most of them, once you get approved for a certain loan amount, that's what you have. If you want more, you have to reapply, requalify, reappraise. In this case, it actually grows every single month, so you're getting additional access to equity in your home on a monthly basis. And a lot of people don't understand that aspect of it, and that's part of what gives you a lot of flexibility. And part of the reason I believe it makes sense to do these sooner in life, because you start that compounding growth to get access. One of the biggest challenges people have is we have this huge asset. We have homes. In most cases, that's our largest asset, but it's only as good as our ability to access the equity in it, right? So historically, to get access to that equity, you've got a few options. You can sell your home. That's one way to get it, right? You got to pay real estate commissions and all that. And then you got to live somewhere, right? So usually that's not an ideal solution unless it makes sense. You're downsizing, or, you don't need a second floor or whatever it is, or want to be closer to the kids or grandkids. But in most cases, selling the home is not people's first choice. The second is a cash out refinance. Traditional loan, getting cash out. The challenge there is in most cases, your loan amount's going to go up and you're going to have higher mortgage payments. The whole secret to retirement is cash flow.
Yes.
Right. All right. That's the game, right? It's a cash flow game. And so that doesn't help, because now you're going the wrong direction in cash flow. Third option is the home equity line of credit, which can be great, very inexpensive, easy to get for the most part. You still have to qualify and be able to meet debt to income. But the challenge with those is you still have interest-only payments, which usually can be manageable. But then most cases, after 10 years, it goes to a compressed amortized schedule over the remaining 15, which essentially means your payments are going up.
Right.
Again, not great to happen in that phase of life. And the real challenge with those, in my opinion, is, I don't know if you or anybody had one of these things when the housing market went down. You look at 2008, what happened to those home equity lines of credit? A lot of them got taken away, frozen. So you hear people saying, hey, my home is my nest egg. This is my emergency thing. Well, that's great, but you have to be able to access it.
Ryan, let me ask you, can anyone qualify for a reverse mortgage, and how do they go about it?
Yeah, so not in today's world. It's a little different than it used to be. Now it is easier from a financial standpoint to qualify than a traditional loan, because if you think about when you underwrite one of these, we're not underwriting their obligation to make traditional mortgage payments, right? Because that part does not become part of the cash flow equation. In the olden days, pretty much anybody could qualify. What we found is there was a gap. And so some of the rules changed a few years ago. And one of the things that is a great misunderstanding historically, not so much today, because again, there's been a lot of safeguards now put in for borrowers, for families that are accessing money this way, where they do still pay their property taxes and their insurance. Okay, so people in the past got confused. You hear a lot of the negative stories about these things in the past. Most of those stories are attached to somebody that was probably told, hey, you never have to make another mortgage payment again. Don't worry about it. And the reality is they still pay property taxes and insurance. And if you don't, that becomes a lien against your home. And so a lot of the bad history was built around that occurrence happening. So today what's in place is we actually do have a couple of safeguards. One of them is what we call a financial assessment, where we have to make sure they have a certain financial capability, primarily around their ability to pay property taxes and insurance. right? So you might realize that's a lower standard than property tax insurance plus principal and interest payments, but it is still a financial requirement to be able to pay those. There are some provisions in place where if they have enough equity, we can do what's called a set aside, where you take out part of what they might be eligible for, and we essentially isolate that to pay property taxes and insurance if somebody we think is on the cusp of having that risk. The last thing any lender wants or HUD wants is for a home to get foreclosed on because somebody didn't make their property tax payment, right? That's a bad situation for everybody. And so there's some protections in place for that. The other safeguard is people go through a third-party counseling, meaning whatever lender is not the only one talking to these families. There's a third party, they're counselors that have been approved and certified by HUD, and they go through and have an additional conversation with families to make sure they fully understand how this functions, make sure it's the right thing for them, that they're not misusing the proceeds in order to protect them as well. So from a who can qualify, is it everybody? No, but it is an easier standard from a general qualification or income standpoint than it would be for a traditional loan.
Well, you've talked about the benefits of, having a reverse mortgage. What are the drawbacks? I mean, my daughter would certainly be upset if I had no house to leave her to, or maybe she wouldn't, but what are some of the drawbacks?
Yeah. So drawbacks are interesting, and thinking about, the kind of legacy conversation of what do the kids get, I think is also a fascinating conversation. A lot of this comes into play around if people have other assets. If someone's in a situation where they can't afford mortgage payments or they need some type of in-home care, that money's got to come from somewhere. So if they have kids, either the kids are paying for it or they're depleting their other accounts. So there's a lot of nuance that comes into deciding what is the right thing for the family and the kids. As far as, kind of the negatives of the drawbacks are, in my opinion, when it doesn't make sense. Two things can happen. One is if somebody is a spender by nature, they put this thing in place and all of a sudden they suck all the money out of it and go, buy boats and jet skis, right? Not super common, but people misusing proceeds can be a bad outcome. So there is, in my opinion, coming from the financial advisory world, there's some discipline requirement around this. It's kind of like, you give somebody a credit card, a college kid, a credit card. Is that good? Probably not, because they may have bad spending habits and misuse it. So there's always that variable. The time when I think it doesn't make sense is more of a timeline decision. If somebody expects they're going to move out of their home within about 2 to 3 years, then I think it starts making less sense, simply because like any loan, there's upfront fees and there's cost associated with it. If you spread that out over the term of the loan, then it makes perfect sense to me. If that's all compressed and you only have about a 2-year time horizon, then I think it might make more sense to let's look at selling the home. Maybe if it's inevitable that that's going to happen, or that's the right thing for them because they want to move to the kids, or again, it's the wrong house for their long-term sustainability, then it might make more sense to sell. You do have the option of doing what's called a reverse purchase. So a lot of people don't realize you can actually purchase a home using reverse loan, which is another really cool strategy for people that are downsizing and maybe have some cash for your next home, but you don't want to use it all. You want to keep some liquid cash available to you, and you do a reverse purchase where you're financing a portion of that purchase, and again, not having to have monthly obligation for payments on it. What
happens if a spouse dies during a reverse mortgage? How is that handled?
Good question. So 2 scenarios. One is going to be where both spouses are age qualified. So in order to qualify for a reverse mortgage for the home equity conversion mortgage, the HUD program, you have to be 62 years old. So as long as both spouses are 62 or older, then there's really no change when the first spouse passes away. The term of the loan is not a term of years. It's more based on lifetime or really somebody that's living in the home. As long as you're living in the home, one of the 2 spouses, then there's nothing specifically that occurs when the first spouse passes away. So that's critically important. The other one is, again, this is a new provision that came out in the last few years. And this is where you have say a spousal situation, and I'll use old husband, young wife, just for the sake of conversation. But, let's say you have one, he's older, he's over 62, he's 65, 66, and she's 59. Okay. So she's not age qualified, but he is in this example. Okay. She is what we would call a non-borrowing spouse. In the olden days, people would remove that non-borrowing spouse from title, take them off of everything, do the loan only for the older spouse. And then when that person passed away, the younger spouse was left having to satisfy the loan terms. She had to pay off or refinance the home. And that caused a lot of problems, right? Because as you can imagine, if they didn't understand that, husband in this example passes away, all of a sudden she realizes she has to pay off this mortgage. That could be a really bad situation. They put provisions in place a few years back that put in protections for that non-borrowing spouse, meaning the loan can still get approved. They're still notated in the document as a non-borrowing spouse. Now, the only thing that would change is when the older spouse passes away, the non-borrowing spouse, if they were taking income or had a line of credit, they would lose access to that, but they would still be able to stay in the home and not have to make any mortgage payments as long as they continue to live there. So those are some unique, I think, pretty cool provisions that were put in not too long ago.
That is, along those same lines, if a couple has a reverse mortgage and they, both die and they have a will and they decide to will the home to the children, what happens then?
Great question. So it's funny, I was in a conversation yesterday and I realized we need to create a program called Exit Strategies from a Reverse Mortgage, right? What happens next? And it'd be an interesting thing to teach because, there's a lot of interesting provisions that come into that, many of which people don't think about. The simple answer is it's the same as any loan you have, right? Where, okay, if mom and dad pass away, they own a home, there's any type of loan on it, at some point, somebody's got to decide what's going to happen to this loan and to this home. Right? So we'll talk through two different scenarios. One scenario is they have existing equity in the home. So they've their home was worth 500,000. They had a loan for 200. They never made payments. The loan's now 300. Let's say the house didn't appreciate. They owe 300. The house is worth 500. Okay. They have equity available. They leave the home to the kids through a trust, through a will, whatever it might be. If there's no trust, some states you might be in probate, which could be awkward. That creates some complexity. So I would say estate planning comes into play here, like in any situation. But the kids then are going to decide what to do with the home, just like they would with a traditional loan. They could refinance and pay off the loan. So they could essentially, buy the loan from the bank or pay off the loan just like they would in a traditional. They could sell the home, and that bank doesn't take title or take over the home when somebody passes away. It can still get sent to the kids. In that example, if they sold the home, they would be eligible after real estate fees to get that, roughly $200,000 in equity would be left to the kids, just like in a traditional loan. Scenario two is, sorry, I don't mean to interrupt you, but scenario two would be, let's say, take the opposite example. They put this loan in place. The loan's grown up, they've never made a payment. So now instead of 200, they owe 300, but we see real estate meltdown. And now the home is only worth $200,000. Okay. Now we're upside down. What happens next? Okay. That's the real risk and question. It's funny. I've done the math. It's not as likely as people think that you get there, but this is the big question. So what happens next? Same situation. Kids have a decision on what they want to do with the home. Right? It wouldn't make sense to refinance the home for more than it's worth because that you don't want to own a home for more than it's worth. So what happens in this case is actually, this is where the FHA insurance is going to kick in. Okay. So there's a unique feature in that it's a non-recourse loan, which means the lender cannot go after any collateral other than what was pledged, which in this case is the home. So I can't go after any other assets of the estate, of the kids, of anything like that as of the lender, right? So nobody can access. They can only go after the home. So they're stuck with whatever that home is worth. In this example, the insurance kicks in and pays off that difference, right? So FHA covers that difference. What's unique here are two things. The kids actually have an option, and this is kind of a little bit unknown, to purchase that home at 95% of the appraised value. So even though the home is worth 200 and they owe 300, they can buy that home for 95% of the appraised value, 95% of the 200,000. So that's a little bit unique, and the insurance is still going to kick in and pay that difference. The one other unique thing, there's actually two other unique things. One other unique thing is that in doing that, if you think about in a traditional loan, if you're familiar with having to short sale a home, So let's say, we're back to 2008, things go upside down, you owe more than it's worth, you sell the home because you don't want the debt beyond the value of your home. It's called a short sale. And you have what's called a forgiveness of debt, right? So the bank is forgiving that deficiency, the amount that you're upside down. And as you probably know, when that happens, you get something ugly in the mail. You get a 1099, right? It becomes taxable income. In this case, because it's non-recourse and because it's being covered by that insurance, it's not a taxable event to the estate or the heirs where they have to pay tax on that deficiency, which is important. And that's not talked about very often, but that's an important benefit to understand. In fact, in some circumstances, and we'd have to get pretty in the weeds for me to break this down for you, but if you think about it, if they haven't made payments over all of those years, what you have is accrued interest. And so assuming that interest qualifies for a mortgage deduction, when that loan is paid off, the heirs could potentially receive a tax deduction for that total amount to the extent they have income to write off. So there's actually some unique things. That's kind of the exit planning reverse conversation. There's a lot of really kind of cool stuff from a planning standpoint that you can do if you're aware of the opportunities.
Earlier, you said, I believe, that you had to be 62. Is there a cutoff age? I mean, can you, like baby boomers are living longer than ever before. So by the time we get to like in our 80s and we're pushing 90, is that something we should be looking at, or we just not think about it?
So, I mean, what's interesting is, the older you get, the more you qualify for. So so here's how the lending limits work. So, one of the questions, how much can I get, is a common question we get from people. And so the answer is, it depends on 3 factors. So the way this is set up is you're going to get lent money. And if you think about it, the FHA is insuring this loan. So they don't want it to go upside down, right? They're responsible if it goes upside down. So they're going to try and run the math to say, okay, how much can I lend you, assuming some appreciation in your home, assuming your age, and assuming you never make a payment for the rest of your life. What is this thing going to look like 3, 5, 10 years down the road, or at your life expectancy? So they're going to try and lend you enough for it to be meaningful to you, but not so much that it's going to be upside down when you pass away, right? So that's kind of the math they're trying to figure out. So if you think about it, will they lend more or less to an older borrower? Well, they'll lend more because you have less time for that debt to accrue, right? So they will lend more to an older borrower because, if you're 80, they're thinking, well, you're probably only going to live for another 7 to 10 years, right? And so, they're going to lend you more at that point because there's less time for that debt to accrue. The same is going to apply to interest rates, more or less in a low interest rate environment. They'll actually lend more in a low interest rate environment because they assume the debt will accrue more slowly because interest rates are low. And the third factor is your home value. So obviously, the more your home is worth, it's going to be a factor depending on the value of your home. So it's a percentage of your home value that they'll determine they can lend. So your best case scenario, older borrower, low interest rates, high home value is going to kind of maximize what you can get. I always tell people you can't control age, right? So if you're looking at this, then really from a timing perspective, what you're looking for is high home values, low interest rates, which interestingly, you could argue is, today we are probably in that sort of perfect storm environment for this, where we've got, some would argue, inflated home values, probably depends on where you're talking about, and we probably have extremely low interest rates. So that the kind of storm is in place for this type of a solution.
All right, so as you probably know, I'm assuming you are invested in the market. As you probably know, the market has really not been kind to us lately. And in your expert opinion, if someone is heavily invested in the market, does that have any impact, or would it have any impact on them considering a reverse mortgage?
So in my opinion, absolutely. Here's why. So when you are in the market, when you're investing in public market, stock market, whatever it is, when you're accumulating assets, right, the market is volatile. It goes up and down. You can look at it over 100 years, say, okay, the average return over 100 years is 10%, or somewhere between 8 and 12. When you look at how many times in that 100 years did the market actually return between 8 and 12% on a calendar year. And it's less than 10 times. That in a calendar year, it's been within that window, which means it's plus 20, minus 6. It goes up and down. I used to use the analogy of, figure you're walking up a hill with a yo-yo, right? The yo-yo is the market. Over time, you're going to get up the hill, but your money's going up and down along the way. When you're accumulating assets, that's fine. It doesn't matter. You have time on your side. When you move from a life standpoint from I'm accumulating to I'm now distributing assets, I'm now living off of the money that I have. I've socked away this money, I've invested it, and now I'm converting that into income. Now there's a huge risk that if you have a downturn in the market and have to take a withdrawal because of income requirements, it can really mess things up. I don't care if you have $1 million, $2 million, you get a couple of down years where you're required to take out money, right? Then you can really mess up your long-term sustainability of that cash flow. So in the financial industry, that's called sequence of returns risk, meaning you can't control the sequence in which the market provides you returns. So where I see this as a really unique opportunity is if you have the ability to put a line of credit in place, and there's actually wonderful math that's been done on this. We've done analysis on this. American College has done analysis on this. There's been books and articles published on it. If you have the ability to have this line of credit in place, in the event you see a downturn, rather than pull from your investment portfolio, you draw from the line of credit. All right. During that year, you allow your investments to recover, and then you convert back to pulling from your investments.
Oh, that's real good advice.
Thank you. It's really fascinating. I mean, it works. And here's the other layer. The second layer on that is most people's primary assets that they have in retirement are retirement accounts, right? They've saved in their 401k over the years. They've converted into their personal IRA. Well, what happens when you take a withdrawal from your IRA?
Mm-hmm.
It's taxable income again.
Yes.
Right. So I need $40,000. I've got to take out 52 to get 40. Right. So it becomes expensive. And now all of a sudden I bump myself into a higher tax bracket. My Medicare expense just went up. My tax bill just went up because I hit this next income threshold. So there's some really unique things to how do you, I would say, optimize your tax bracket, where you can look at supplementing income streams where I'm not having to pull from my retirement account, right, until I have required. But I can now start supplementing this, using this as an alternative, because when you take money, it's loan proceeds. So it's not taxable income when you're pulling from the equity. So now you can start maneuvering back and forth between the two and really starting to hone in. And what this ends up doing is I would call it longevity. It stretches out your long-term cash flow. So instead of running the projection where you run out at 82, you start throwing this, and now we've got you till 96 without telling you can't go to Starbucks or, go golfing anymore, whatever it is. So you start being, I don't have to create behavioral modification for people as a planner, right? I can just basically tell them, hey, we can restructure things, keep your lifestyle, and still extend your cash flow.
We could really talk another 30 minutes, but unfortunately time is running out here. So I'm just going to ask you to give us some closing thoughts. How can someone reach out, get more information through AAG, maybe contact you personally, do their homework, etc.?
Yeah, great. Thank you. This has been fun, Beverly. This is a hoot. I love these conversations, and you've been great. So I guess the easiest thing, we have access to our website. It's aag.com. Couldn't be any easier. There's a ton of information on there. For people that are in the professional industry, if you're, financial professional, or even in the healthcare space, we have a lot of people that do in-home healthcare, where there's probably one of the greatest risks people face today is the need for long-term care. I need somebody to come care for me. And it used to be 90% of the people want to stay in their home. I haven't seen an updated statistic, but I'm going to guess after COVID, it's about 98% of people that don't want to go to a facility. And so this can become a great resource there. And there's a little section on our website that says for professionals. You can click on that. That will give you access to a bunch of content for different types of professionals that are out there. Me personally, you're welcome to reach out to me. There's a contact sheet there to reach our team. I don't know how we post information, but my email is simply rponsford@aag.com. And I'm happy to take emails. I love responding to these types of requests and questions. And we've got a whole team of people here to serve you. We are really in the business of how do we create better retirement outcomes? How do we look at this holistically? How do we understand your big picture and see how can this help you extend cash flow, get access to liquidity, and what is the impact on your kids down the road? And if we can improve it, we'd love to help. If not, you don't need us, right? So keep it simple.
Awesome. All right. Well, listen, thank you very much for taking time out of your morning to talk with us about reverse mortgages. And thank you to everyone who will be tuning in to this particular segment of the Boomer Beat. And remember this, stay empowered along your journey. See ya.
Good news you can use for your life. If you